Thursday, December 23rd, 2021, Monaco 64, home of alternative economics and contrarian views. The video today will be a little different. I'm going to go over the markets in a minute, but after that, you're going to be able to listen to an interview I did with Rafi Farber yesterday. It's about 35 minutes long. And we spoke about inflation, deflation, what's happening to prices. And Rafi's conclusion is that, yes, there will be a great reset, but it won't be on the globalists' terms. It will be a runaway boom or a crack-up boom. It will be from the bottom up. It will be the public basically saying no more to the theft of inflation, and I think you enjoyed that interview. And with that, let's look at where the markets are then this morning. It's 8:30 a.m. London time. We've got spot gold at 1806.80. It's up just over $3. Our range has been 1808.80 to 1796. I think the key resistance is going to be around 1810. There's a trend line from last week that was around 1812.13. And if you look at the high last week, it touched that line. And that line, of course, has come down this week. So it's around 1810. Of course, not many days left until Christmas. Saturday, Friday tomorrow will be probably a little quieter in terms of the markets. And then next week, it's the run up to the new year. It will probably be a little quieter, but albeit there will be trading in the markets. It could be quieter than usual, but maybe not, because I think a lot of activity has been done from away from the office. And who knows? We'll have to wait and see. What about silver? Well, silver is at 22.86, is up about 6 cents. So outperforming slightly gold, but not that much. I've got 23 as an important level in the short term, even medium term, I would say, because if you look at the high from last year and the high this year around 30, and the low from March last year when silver went below 12, the 38.2% retracement from the top to the bottom is at 23. And as you can see on this chart, we've been below that 38.2, of course. We almost got to the 50%, and 38.2 is a key retracement level, I would say, in markets. So we're going to keep an eye on that. The range has been 22.92 to 22.72 in silver. To the stock market, the Dow futures up 40, NASDAQ futures down 3 points, S&P futures up about 4 points, just below 4,700. The FTSE is up 15 at 73.35. To the currencies, sterling has continued to rally here. We've rallied the last few days a little bit in sterling. It's up 0.25% at 133.83. The euro is unchanged, 113.22. The dollar's up slightly versus the yen, 114.29. Versus the yuan, the dollar's down slightly at 637.52. Aussie dollar is up 0.33% at 72.36. The dollar's down 0.125% versus the Canadian dollar, 128.17. And the Kiwi dollar is up almost 0.5% at 68.33. To the commodities, WTI crude is down 0.5%, but we're at 72.36. I think yesterday we were trading 71 when I spoke. So that market is creeping up. High-grade copper unchanged virtually at around 439. We've got U.S. nat gas down 1.5% at 381.60. And to finish off, before we move on to Rafi's interview, the 10-year yield is unchanged at 147. So I wish you all a great day. And yes, here's the interview. Today I have the pleasure of speaking with Rafi Farber of the Endgame Investor and also of Rafi Farber on YouTube. You should check out his YouTube channel. It's a very good channel. It's a relatively new channel, and I highly recommend it. Most of you know Rafi. He's been a frequent guest during the live streams on Sunday, but today this interview has been conducted, of course, on Wednesday, December 22nd. And I wanted to talk to Rafi about inflation and deflation, the debates that we see out there. Many people think we are going into a deflation or even in a deflation, even though we're seeing prices go through the roof. That is consumer prices, not just asset prices or paper assets. And we also want to maybe cover, Rafi, if you can, after we look at inflation, deflation debate, a little bit about how you think the powers that be, their great reset will fail, and we will have basically a great reset, a natural great reset, which probably won't be pretty, but it will be the best hope, I think, like you do, for the future. So welcome, Rafi.
Hi, Mario. Good to be back here.
Great to have you back on the channel. I think you haven't been on the channel for a while. I was on your channel last week. I enjoyed that. So yeah, I see, as I said, a lot of comments sometimes when I speak about inflation or deflation or hyperinflation. People mention other commentators out there, even in the alternative, who actually are still claiming that we have deflation only because they're looking at bond yields, treasury yields, which, in my opinion, have been heavily manipulated. And if we hadn't had all the inflation, currency, and credit creation to buy those bonds, it would be a different story. What's your take on this?
Well, first, just generally speaking, when we're talking about inflation, we're talking about the blowing up of asset bubbles, of prices, and and whoever's doing the inflation hopes that the inflation goes into assets and not into consumer prices, but wherever it goes into is determined by the people who are buying things and selling things, not by the person who's inflating or the institution that's inflating. So where it goes has to do with mass psychology. There's no one thing of inflation or one thing of deflation. Some things inflate, other things deflate. Prices go up, prices go down, and we can pin the words inflation or deflation based on trends that we see. But there's no one thing called inflation of prices. I mean, or deflation of prices. Some prices go up, some prices go down. That's how it always is. When people are looking at the debate going on now, it's people overthinking things. I mean, that's most of economics, is just overthinking, not bringing it down to the simplest of concepts. And I'm going to try and bring it down to something really, really simple now. And it's not going to sound normal, even though it's the most normal of things. But when you look at bond prices to predict anything, really, when you look at a bond yield, and let's say what's the 10-year at, like 1.5, 1.6, or whatever it is, and the consumer prices are rising at about 7% according to their manipulated statistics, which probably means 10 or maybe even 15%, depending on what you buy. There's no one number, no matter what index you use, but it's a lot higher than 1.5%. Like you're going to lose money if you're going to buy a bond. So what are bond prices really telling you? They're telling you in the most basic signal that everybody is immortal, that nobody's ever going to die. And that's impossible, because we're all going to die. They're telling you that nobody has any time preference, because real interest rates are negative, and if real interest rates are negative, then everybody lives forever. It's impossible for a human being to have negative time preference, to not care if he has a good in the present versus a good in the future. You always want a good in the present, and you only take a good in the future if you're going to be paid for your time of waiting, because you don't have forever to wait because you're going to die eventually. So a negative real interest rate means the bond market is predicting that everyone's going to live forever, and that's absurd. So in the same way, you can't say the bond market is predicting that we're going to have inflation or deflation or whatever, because the bond market prices are only predicting one thing. They're predicting what the people in the bond market are predicting the Fed is going to do. And apparently now the people in the bond market who have these huge positions in treasuries, they're predicting that the Fed is going to buy more and more bonds because they have to, and they're going to make a quick buck on selling it back to the Fed. That's what they're predicting. Maybe they're right about that, but if they are, it doesn't mean that consumer prices are going to go down. It just means the Fed is going to create even more monetary units, and wherever it's going to go, it's going to go. It's going to go into wherever has the most momentum, just like bond markets keep going up because it has the most momentum.
So I guess then the bond market is completely irrational and is a complete bubble. It doesn't mean anything anymore.
No, it's not completely irrational, because people are buying. I mean, the institutions or whoever is buying all these bonds are buying it for a reason. I mean, even central banks who buy bonds, they're buying it for a reason. Even if you say it could be possible that the bond market is basically one central bank buying from another central bank and just passing the bonds between them and driving prices up that way. That might be actually what's happening. But even so, like you have these hedge funds or whoever buys bonds in the middle that are trying to like clip off a few bucks here and there from this trade between central banks, and that's rational. I mean, they're trying to make money. But when you're trying to make money by clipping off a few percentage points on what central banks buy from each other, that's not going to help anybody, even in the medium term. It's a very sick economy. Like when you have a heroin addict or a drug addict that's taking another hit, I mean, yeah, he's doing something irrational, and then he doesn't want to experience the pain of withdrawal, but like, you know that he's killing himself, and we can see it. And this is how humans act when they're self-destructive. They're doing it for a reason. It's not entirely irrational. It's within human nature to do that. But then you got to say, okay, but this is going to end, and it's going to.
So do you think they could keep interest rates low for a long time? And I think they can, but just wanted your opinion. Could we see a point where, because like Japan, we're told that they've had deflation for 30 years or so, but if you look at the price of the yen in gold, it's gone from about 60,000 to 200,000. And yes, the JGB is 0 or negative yield or thereabouts. So what I'm trying to say here, we could see the bond market remain bullish and yields down, but you could see the currency underpinning that be completely destroyed versus real money.
Yeah. Well, look, on a theoretical level, yes, central banks can keep nominal yields as low as they want or as negative as they want for however long they want. But what they can't do is give the currency, maintain value in the currency. They can't do that forever. So the question is like, yeah, so if we have a situation where the central banks are going to keep yields down for X amount of time, what is the unit X minus Y that they can keep the currency having any value? And that really does not depend on them. It depends on the public. And you know, as little and powerless as we think we are, you know, the public outnumbers the hedge funds, it outnumbers the institutions, it outnumbers the big banks. The public outnumbers everybody, and the public does not act as a single entity consciously. But once it gets going, nothing can stop us. Once the consumer prices start climbing and people start getting scared, you know, just like we got, and I'll use code words here, just like we got into this situation that we're currently in, this current health situation through fear. and they used fear to mobilize the public to do what they wanted it to do. And that's where we are now. And people like us, we never really gave into it, maybe for like a week or two at the beginning because we didn't know what was going on. But now like, we understand what's going on. This is just a fear play for them to control people. But fear is a double-edged sword, because once people fear for their monetary health, and they see their savings are evaporating and they need to get what they need to get right now and buy right now, there's no way the government is going to stop that fear on the other side. The fear that they're stoking now is going to come back and hit them. Everything. What's that saying? You get what you dish it. You reap what you sow. You reap what you sow. They're sowing fear. So when the fear hits the currency, it's going to come back and hit them, and they can keep yields at whatever they want, but the public will dump all the currencies all over the world, and that'll be the end of it. And that's what's coming, and they'll return to what? The gold and silver. That's what's going to happen. That's what happens every time. And it doesn't matter what the technology is or how smart people think they are. We're the same species that we were 10,000 years ago. Nothing has changed.
Yeah, so it's all going to be based on fear, and I agree with that. And we've seen that happening already in countries like Lebanon, Turkey now, with the Turkish lira. And just wanted to ask you, because a lot of people think that, and I know this is like wishful thinking, that the Fed will raise rates 3 times next year, that's going to hurt gold prices. So just wanted to ask you about, you did a video last week or the beginning of this week, and it was really interesting, where you looked at M2 money supply growth since 1980, and you also looked at it in the 70s. And it's one of the things that I've said to my viewers, that the inflation has been baked in the cake since the early 80s, when Volcker was able to salvage the system. And people are still, in my opinion, pretty much, they're not aware of the fact that the inflation now is starting to flow into the part of the economy that the central bankers and the bankers don't like. So could you go over that, the relationship between M2 and also the CPI index, how to you it's pointing to what Rothbard calls the runaway inflation?
Right. So first of all, I'll go over what Rothbard says in Man, Economy, and State, and then I'll show you the charts. So Rothbard basically kind of lays out the inflationary process in very broad terms. The first stage is like the government prints money and prices rise a little bit, and then people think like, prices will stop rising eventually, and so I'll keep my money now and I'll spend it later. And the fact that they keep their money now in order to spend it later means that they're actually helping the government take more real resources away from them. But it doesn't necessarily mean that prices will go down or anything like that, but it could be that they'll be earning more money than later, more than prices will rise, and that can keep the inflationary system going for long. As long as people keep producing more than the government steals from them through inflation, the inflationary process will continue and continue. And it can last for many decades, as it's last for 50 years. And we see that the money supply from 1981 to around now, to around 2020, let's say March 2020, has gone up a lot more than consumer prices have gone up. People have earned a lot more money than they've had to spend during this time. So here I'll share screen here, and I'll show the 2 charts, the point that I wanted to make here. So here, this chart, am I sharing it right?
Yeah, that's great.
Okay. So here in the blue, you see the US M2 money supply. And here we have it's increased, right? Basically since 1981 until 2020, around 780%, whereas consumer prices have gone up only about 175%. So most of the inflation in the money supply has gone into asset prices, stocks and bonds mostly, some real estate, those kinds of things, but not in consumer prices. Some of it has gone to consumer price, but not all of it. So here's the second chart. Let's see. Yeah. So this is 1971 to 1980. This was just after Nixon closed the gold window, and the global society was getting used to the fact that the reserve currency was no longer backed by any gold. So there was a lot more panic in terms of the value of the dollar. And you see here that the actual inflation proper, and the inflation of the money supply was up 115%. And the consumer price index, consumer prices went up almost 1-for-1 for that, for 150%, to 88%, very close. So back then in the 70s, we saw that the government really couldn't get away with the inflationary process nearly as much as it could from 1981 until now. The third chart, which I don't have here, but you can look it up yourself. You look up around from since the consumer prices, since the CPI started taking off, maybe around April or May. I don't know the exact month, but the last few months, the inflationary process in terms of the money supply and the rising consumer prices have been going up very close to the proportions they were in the 1970s. So we're returning closer to a 1-to-1 ratio. And the hyperinflationary stage of that is when the people realize this and they start getting in front of the inflation. And that's when you see consumer prices rise much faster than the money supply rises. And that's when the government can no longer extract any resources from the public through inflation, and the money substitute dies. And that's why a great reset cannot really happen on their terms, because once they control the economy through their money substitutes, through their currency. And once that dies, they might have some gold, but even if they have some gold, the public has a lot more.
Yes, I think gold reserves, official gold reserves held by treasuries and central banks is only about 17% of all the gold above ground. So you're right about that. I mean, at the moment, they have enough gold to control the price with their paper shenanigans. But once there's fear and the public wakes up, they will be overwhelmed. Here's a chart of M2, and I've got it here so people can see that M2 is just picked up massively since the beginning of the end of the world as we knew last year, as you said before the video. So, and it's continued to grow. And we have, as I said, we haven't got the CPI index, but it's starting to follow it much closer. I think from your video, you said that the M2 is growing around 8% now in 2021, and the CPI is growing around 7. So it's almost 1-for-1, right?
Yeah, according to the CPI now, but the CPI in 1980s was much different. So I wouldn't be surprised if on a more accurate measure we are 1-for-1. And there is no one accurate measure. There's no real measure here. This is all just general feeling. I mean, we're like dabbling in economic voodoo here a little bit, which we can't avoid doing. But this is the best that we can do. And yeah, consumer prices and inflation proper are going much closer to lockstep than they were in the last 40-45 years, definitely.
Do you see all these crises we're having? Like we had the squeeze in lumber, which was early this year, and it looks like lumber is picking back up now. We had the supply chain problems, which are still there. We had earlier, I think it was probably August, September time, the fertilizer crisis, and now we're seeing the energy crisis in Europe is getting really out of hand. I think prices are going crazy, and I think it's going to lead to the shutdown of big parts of the economy. And some people would argue, well, yeah, economy shutting down, that's deflationary because people are going to spend less money. But I would argue that if you look back at currency collapses or hyperinflation, what Rothbard talked about, it usually happens when the economy is on its knees and there's a lot of fiat debt around. Do you see it like that too?
Yeah, I mean, the less, there's gonna be less spending, yeah, on discretionary items, but did the lockdowns lower demand for food? No, people have to eat what they have to eat. I mean, that means all spending power goes into the most basic necessities. That's what hyperinflation is. When you're in a hyperinflationary economy in Zimbabwe or Weimar or any of the other places that have hyperinflated, yeah, spending in every discretionary area, like going to the movies or going on vacation or buying luxury cars, go way, way down. Why? Because everyone's spending all the purchasing power they have on basic necessities. That's what happens. So yeah, you're low in a hyperinflationary economy, you're lowering demand for almost everything except basic necessities, we're seeing the beginnings of that process now. I mean, I'm reminded of did you first of all, Mario, how is your electric bill?
Yeah, it's probably going to go up quite a bit. The latest one wasn't reflecting in that, and also in April here in the UK, that's when the cap for the electricity suppliers is going to be lifted. So yeah, it's going to go up quite a lot.
Well,
Not
let us
just
if you're comfortable with it, let us know. I don't want to ask you personal information, but
no. I mean the last we have a direct debit, and it's still the same as it's been in the last few months, but I expect it to go up a lot. It hasn't gone up yet, but I'm ready. I'm prepared to see it go a lot higher. And I think a lot of people are not. And the other thing, I was looking at the German situation, energy situation. I didn't realize how bad things are there, and that whole industries could be shut down for months because people are going to favor using energy to survive than to produce things.
yeah. So that means everything. I was reading that energy intensive industries, right? And food is one of the most energy intensive industries, and all basic chemicals, which is fertilizer, all these things are going to shut down because they're going to sell their power to the electricity industry so people can heat their homes. Basically, I mean that's what's going to happen. I mean what you were saying about lumber and now the energy crisis, and we have these like different crazy peaks that are happening at different times. It reminds me of I saw that miniseries Chernobyl, right, on the explosion of the nuclear reactor in Chernobyl, and they showed a scene of how it actually physically manifested itself, right? You have these like control rods that are like these very, very heavy carbon rods that go up and down and up and down. And like closer to the explosion, you saw like some of them went up and then went down, and then others went up and went down, and like they would just like jump up and down really fast until right before the explosion, all of them were up. And then all of a sudden, boom. So like that's what we're seeing. We're seeing these different spikes in these markets, and they keep going up and down, and the inflation or the rising prices, they show up in a different sector of the economy, and then the money wave moves to another one, and we're going to see more of them at the same time now, and then at the very end, when this is about to blow up, we'll see the prices of everything going up all at the same time.
I noticed, I think you touched upon, I'm not sure if it was one of your videos or the newsletter, that a lot of people think that the stocks are a good hedge against hyperinflation, and they could be, but they're not the perfect or ultimate hedge. And you noted that the Turkish stock market, I think, has gone up 70% this year, but the lira went down 230% versus gold.
That was I'm not sure if that was the stock market or real estate. It could have been. I think it was real estate.
Oh, real estate. Okay.
Yeah, yeah. So Turkish real estate has gone up 75%, but versus gold and silver, it's gold and silver have gone up like 200-300% or something like that. Where no, the point was that gold and silver are the clear victors in terms of inflation hedge, versus real estate, because more people need money than people need real estate. People need real estate, but everybody needs money. So in a hyperinflationary scenario, everyone's going to go after money. Some people are going to go after real estate. So money is going to go up faster than real estate. And with stocks, I didn't look at the actual Turkish index because I don't know where to find that. But I looked at the Turkish ETF, the TUR ETF, and the stocks are way down. I mean, Turkish stocks are way down while this hyperinflation is going on. And if you look at Weimar, the Weimar stock market went up about 80 times versus like what it was like 2,000 times consumer prices or something crazy like that. So forget about the term inflation hedge. What's being inflated is the money. So in order to hedge yourself against that inflation, you need just money that's not inflated. That's the basic logic.
Yeah, and that's gold and silver. And I saw a story today in the FT about China and the very wealthy there. Apparently, they're diversifying now out of real estate, which is understandable with what's going on in real estate. And they're actually buying luxury watches like Rolexes and Patek Philippe's because they're concerned about inflation. So even the wealth Chinese are moving into things like fine watches, and one of the reasons they're getting the watches is that they're able to go abroad and take that as money, because there are rules in China when you go out how much money you can take, and according to some of these people in China, the people at the airports and security, they don't know much about the watches, or you can wear the 100,000-pound Patek Philippe around your wrist, take it, go to Switzerland, sell it somewhere, and park that money outside, or maybe buy some gold outside.
Right. It reminds me of a story. I think I read it on Lou Rockwell many years ago. Somebody maybe leaving Russia or somewhere in one of these communist countries. Basically what he did was like, he wasn't allowed to leave with anything but one suitcase. So he sold all of his stuff and he bought platinum or some kind of precious metal, and he made hangers out of the platinum. So he had his coat bag, and he put his suits and suit and ties, like he hung it on hangers, and he put the hangers in the coat bag. And then he sold the hangers and got his wealth back.
And that's a good one. And there are some gold bars, for example, that are rounded. And what I've heard about that is that there's a lot of smuggling of gold into India, years ago, decades ago, and even now. And it's an easy way to swallow the bar. It doesn't cut your throat. So it's like rounded. And then when you get to India, you go through security and immigration, and then what you do afterwards. You go to the toilet and then it comes out. So yeah, there's many ways that you can protect your wealth. Some people would argue, Rafi, that it's much easier with cryptocurrencies. You don't have to carry it around. What's your view? Will it be a good insurance against currency collapse or the inflation of the fiat currency system?
Well, I would have to say that if I was like on my way to a flight out of a country to like escape tyranny, and I knew I'd be landing in the next country like in like 12 hours or 6 hours or whatever, I'd probably prefer to put all my wealth in Bitcoin, knowing that I'd be able to sell it 6 to 12 hours later, than swallowing a gold bar
Yeah.
and then having to search in the toilet for it later. So, assuming we're not in the very, very end stages, Bitcoin could be a very useful way to save your digestive system some stress. But in the very end stages of it, when grids are collapsing and we don't know what's going on, and people are really living in fear of what is going to happen tomorrow, then I don't see Bitcoin as maintaining much real value at all, if it even survives. I mean, look at this energy crisis in Europe we're happening now, and things are still, there's no chaos, there's no like zombie apocalypse yet, but this is just going to get worse. And like, if the electricity grid goes down, what happens to Bitcoin? The entire thing is destroyed. Bitcoin exists because miners continue to do work. Gold exists because God created it, and there is a universe, and there are atoms and quarks and leptons and all that stuff, and it's not going to go away. So in a real SHTF scenario, it's 100% gold and silver. if we're just right before, if we're before a collapse and things are still kind of functioning, you got to get out of a country and you don't know what to do. Yeah, Bitcoin could be useful, sure.
And in terms of the hyperinflation and the final collapse, how close do you think we are? And do you think some people will argue that it's not a currency collapse, it's all because of the lockdowns and the supply chain problems? What do you say to those people?
Well, the lockdowns and lockdowns, they're just going to increase demand for food and decrease demand for other things. But the supply chain problems are an effect of the monetary problem. They're not the cause of it. When you have too much money and not enough stuff, then markets take a while for the money to be absorbed. So if it can't be, then you're going to have shortages, which is the supply chain problem. But and when do I think it's going to happen? I don't know. But what I can say with more confidence is that, for example, in 2008, the central bank was able to put the brakes on everything, which is, they did that. If you look at the money supply growth bottomed out in mid 2008, around June, July, August. There was the money supply growth stopped, dollar supply stopped growing, and that's arguably what caused the crash in the first place. So they're not, and then we had another reset of about 10, 12 years until now. But what I'm confident saying is there is no more room for another reset. It's like if the inflationary process is theft, right? And then inflation is too high, which it was in 2008. Consumer price inflation, consumer prices, and they were going up too fast in 2008. So then the central bank realized, oh my God, they're realizing that we're stealing too much money from them too quickly, and they're going to start getting out in front of it. So then they stop the money presses, right? And then they try to slow it down so that we stop realizing that they're stealing, and then they reset the whole thing for another 10 years or so. So they can try that this time, but inflation is already out of control, and people are going to wake up to the fact that they're being stolen from, and they're not going to be able to reset it for another 10 years. I think this is the end game in terms of the money supply growth is going vertical. It's not going to stop here. How long it takes for the full end, I don't know exactly.
So to those people who think that Rafi talking about theft, I'm going to reference a book I've referenced before. It's called the Raven of Zurich, the memoirs of Felix Sommeray. He was a really influential banker, in the early part of the 20th century. And on page 98, you can get this book online, free PDF. I'll put it in the description. He says here, the state alone is responsible for inflation. Inflation without governments, or indeed against government, is impossible. So yeah, it is theft, because basically they're stealing from present taxpayers by spending money they don't have and putting it, lumbering the national debt on us and our children and grandchildren. So yeah, it is theft. So Rafi, can we wrap up here, and maybe you have some final thoughts about this inflation, deflation, and hyperinflation debate?
Yeah. Well, my end thought. Let's see. I have a book in the back here. I'll bring it out.
Yeah.
This you brought a book here. One of my books.
The Book of
This is
Beliefs.
a book by Saadia Gaon, The Book of Beliefs and Opinions. It was written originally in Aramaic, I think, and what he says there. One of the things he says there. It was written, I think, around 800 or 900 of the Common Era, and one of the very early, one of the first Jewish philosophical books. This is basically a very logical statement that you cannot have a world that's based on theft. You can have some theft in a world, right? Like there's always thieves, there's people who steal from you. You can't have a world where the central pillar of it itself is theft, because then you have everyone stealing from everybody, then nobody produces anything, and then then you won't have anything to steal, and then everyone starves to death, which is, we've seen it in communist countries that the government steals everything, there's nothing, and then everybody dies. So that's just what happens. So if inflation is theft, and inflation is now considered, since 1971 to be a good thing, because 2% inflation a year is like what you want. So even if you say, oh, a little bit of theft is good and legitimate and let's do it, then eventually you're going to collapse society. It's going to take some time, but yeah, it's going to end. So the inflationary process is institutionalized theft at the very centers of society, and you can't have a society that survives in that for very long. It's going to end exactly when, I don't know. But yeah, there's going to be no more deflationary the dips in this. We're in the end stages now, I'm pretty sure.
Rafi, thank you very much. I wish you a great holiday season. I know you already celebrated Hanukkah, and thank you very much for being on the channel.
Thanks, Mario, and Merry Christmas to you.
Thank you.